Hello, everyone. With the Greenland dispute being resolved, the Trump tariff threats are off the table, and the market recovery has started. But what comes next? So, hello, everyone, and thank you for joining me live for our macro outlook, where we break down the markets the way we see them. Moving forward, I'm going to be doing this live Monday through Thursday every morning at 9:30 a.m. Eastern. So, if you're loving it, plug us into your morning routine. So let's dive in what's going on here in the market. So here, as you can see, I have the chart of the S&P 500, and there was that one-day scare that came in over the weekend and the shortened holiday week over Columbus Day. Market decisively slamming below the 50-day, but then suddenly Trump the next day is in Davos, and everyone's buddy. They come to a solution, and here we are with the market well on its way recovering that one-day drop. Now, of course, when you have a headline driven drop like that, that is not structural in its nature, it's reactive. And the fact that this was a threat and then immediately resolved is the type of stuff we've seen from Trump's tweets repetitively over the course of the year. What though comes next? What do we have to put into the frame? Well, look, the market did recover, right? So the S&P is bouncing higher. The strength, though, where is it coming from? First of all, the breadth of the market back to 69%. And so overall, the breadth of the market is still in an upwards trend. This is coming and visible in the sector rotation theme I talked about yesterday. You can observe here, look how fast the S&P 500 equal weight, where every component of that S&P 500 has the same weighting and not this Mag 7 lump of stocks controlling one third of the index. So in this scenario, look how fast it recovered. We're right back to 52-week highs here and on this. Then you take a look at the small cap index, also continue to rip 52-week highs, right? So you have this component of the market working, but then what's not working? And that continues to be the Mag 7. Look how ugly the Mag 7 chart looks. This is the Mag 7 ETF, which is the 7 stocks in that basket. You can see this recovery incredibly weak. We're nowhere near even approaching the 50-day moving average at this stage. And so we have a situation where we've continued to see a lag here. There is one important thing that can happen for the bulls, and this is where I want to look at it from a bullish perspective temporarily. The Mag 7 stocks, I'm going to pick on Apple, have been incredibly oversold. Microsoft, just as bad. You had this basic selling for 2 months where, for instance, Apple over 48 days has lost $46 or 16%. These things are oversold. And next week, we have four of the big boys all coming out with their earnings within a 24-hour window. Now imagine this like elastic between your two fingers. These oversold markets are stretched, that elastic's really stretched. So it's very easy for them to accidentally say something bullish in these earnings that could actually create reactions the opposite direction. If we see the outcome next week that these Mag 7s are reacting with bull gaps on those earnings, with the rest of the market doing so well, this could be what the S&P needed to get that slingshot to actually punch a 52-week high on the main market cap weighted index that we track so much. To the negative side, the Mag 7s are that important that if the opposite happens, where they're disappointing on those earnings reports, then that almost certainly would be putting in a top on the market. Point here, so we don't want to use too much technical analysis when we're going into the pig and the python moment of earnings that is actually going to set tone for a lot of things and influence sentiment considerably. So while the S&P 500 has certainly brushed off the Trump tariff threats on the short term, we have the FOMC meeting next week and these earnings, and they're going to play a really important part to determine whether the market cap weighted index is going to be able to break to a higher high. Nonetheless, sector rotation remains the theme. One sector that I'm watching particularly is the financials, the XLF. Now, the financials had a scenario where we had a bunch of earnings misses on JP Morgan. We had an earnings miss on Bank of America. Citi went down. Wells Fargo went down. They all began a correction. Now, I usually like to see when a beta one sector like the financials is actually confirming trend. And the fact that we've weakened now just below the 50-day moving average, but directly into a 61.8 retrace. And so right now, one of the things we're watching is whether the financials can also turn back up, get back above the 50-day, and resume in trend. If we see a scenario where Mag 7s are lagging, the financials can't recover, that's going to put some question marks into the latter part of January and potentially into the first week of February, and that's where we'll do that. But before we start worrying about that, I think we have to cross this bridge first and see how things really shape up in the middle of next week. Okay, so the S&P 500 could easily retest a high. We'll see what happens here. Now, the dollar index still very neutral. Now, it certainly did take a spill, didn't recover very well, but came from a move in the euro. And when you're looking at things like the yen and other currencies, there's still a big muddle. To call this ready for a new leg down on the dollar index, it's a little premature, but there is a very clean line in the sand that you can use, and that's the lows around 98 that were the lows put in December. Because if the dollar index broke down that way, and particularly if it's confirmed with yen strengthening, which has been one of the weakest currencies at this point and quite oversold, that would be where I would be willing to get a much more immediately bearish the dollar. So there's a little bit more work to be done there. The last thing I want to touch on here before we wrap things up is where we are with gold and silver. Now, gold just continues to rock and roll to the upside. Now, we talked on this channel numerous times about the measured moves up here toward 5,000. And here we are, a stone throw away from 5,000. So we've really now seen this fully play out. Now, I'm not bearish gold. In fact, I remain and have always been a long-term gold bull. And by no means am I trying to be alarmist from a bear market perspective on gold or something crazy like that. But gold still moves in ebbs and flows. And when an impulse finishes, it pauses and mean reverts. In the last year and a half, we have seen every one of those pauses, and there's been five of them, happen to consolidate sideways. But that's kind of weird that each time, each consolidation kind of follows the same playbook. And the question is that now, if a bunch of traders are expecting the same thing to happen again, will gold play it out slightly different? Point here, there's lots of room for gold to shake out those highly leveraged up traders, those people that have been leaning into this over and over again. And as their capital and collateral increases, they buy more and they keep compounding, trying to press the trade higher. Inevitably, the market usually punishes those traders with a shakeout, and that reversion is purely a liquidity event, nothing fundamental. At some juncture, as we get to these upper levels, there's going to be a lot of froth and a lot of excitement about these 5,000 print. And I'm going to be far more worried that the asymmetry is no longer skewed in our favor on the bull side. This is something that I'm watching very, very closely with our members as we move forward. The last thing, just on silver. Silver here remains up along its highs. The measured moves are actually to that 100 round number. No reason why we can't still print another $5-6 higher up there. But both gold and silver for this technical impulse are looking rather ninth inning-ish, where the game has been played, and at some stage you shouldn't be surprised if we had some profit taking and a little bit of reversion in the prices settling in for a little while. All right, this is where I'm going to wrap up the public part of the live stream. From here, I'm going to jump on with our Big Picture Trading members, where we're going to be taking a look at all of these things from a trading perspective. We have a number of these trades on all of these, and many of them need to be dealt with. Obviously, oil's been pulling back. There's been huge rips in so many of the basic material names, and lots of new opportunities in trades, like for instance a turn up in home builders and other areas that we're watching. We're going to be discussing that all inside our membership. Today's webinar is almost exclusively focused on commodities, and this is, if you're a commodity lover, this is a great session to be joining in. If you'd like to join and see how we turn all of these ideas into actual trades, you're invited to join a free 14-day free trial at Big Picture Trading. Just click on the link in the chat or go to bigpicturetrading.com and hit that 14-day free trial button. Once you're in, you'll be able to continue watching in the private member area stream. I don't have it up here, but there's this where's the trade icon on the right hand side that has a big orange button that says join now, and when you click that, you can join all our members in the live webinar stream where we're going to be analyzing the markets. For anyone else on the public side here, thank you for joining me. We'll be back on Monday again at the same time. And those starting that trial, we'll see you inside in a few minutes. Thanks, everyone.